is included in a monthly mortgage payment? A monthly mortgage payment typically includes several key components that cover both the loan and the costs of owning a home. First, there's the principal, which is the amount of money you borrowed to finance the home. Each month, a portion of your payment goes towards gradually reducing this balance. Second is the interest, which is the cost of borrowing money from the lender. This is calculated as a percentage of the remaining loan balance and is usually higher at the beginning of the loan term, decreasing over time as the principal is paid down. In addition to the loan repayment, most mortgage payments also include property taxes. These taxes are assessed by your local government and are typically collected by the lender in monthly installments, held in an escrow account and paid on your behalf when it's due. And another important part of the monthly payment is homeowners insurance. Homeowners insurance protects your property against damage or loss from events like fire, theft, or natural disasters. And if you made a down payment of less than 20%, your lender may also require private mortgage insurance, otherwise known as PMI, which protects the lender if you fail to repay the loan. Together, these components, principal, interest, taxes, and insurance, make up what is commonly referred to as a PITI payment. What are closing costs and how much are they? Closing costs are the fees and expenses you pay when finalizing the purchase of a home and officially transferring ownership from the seller to the buyer. These costs are separate from your down payment and typically include a variety of charges such as lender fees, title insurance, escrow fees, appraisal fees, attorney fees if applicable, and prepaid costs like property taxes and homeowners insurance. Closing costs also often include fees for credit checks, loan origination, recording with the county, and more. The total amount of closing costs can vary depending on the price of the home, the location, and the type of loan, but they generally range between 2% to 5% of the home's purchase price. So for example, on a $300,000 home, closing costs could fall between $6,000 and $15,000. Buyers will receive a detailed breakdown of all closing costs in a document called the loan estimate shortly after applying for a mortgage. And then again on another document called the closing disclosure at least 3 days before finalizing the transaction. What is PMI, private mortgage insurance, and do you have to pay for it? Private mortgage insurance, otherwise known as PMI, is a type of insurance that protects the lender, not you, in case you stop making payments on your loan. It is typically required when you make a down payment of less than 20% of the home's purchase price. Since a smaller down payment means more risk for the lender, PMI helps to reduce that risk. So if your loan requires PMI, the cost is usually added to your monthly mortgage payment. The amount can vary, but often ranges from 0.3% to 1.5% of the original loan amount per year, depending on factors like your credit score and loan terms. So for example, if you borrow $250,000, PMI could cost anywhere from about $750 to $3,750 annually, or around $60 to $310 per month. You don't have to pay PMI forever. In most cases, once your loan balance drops to 78% of the home's original value, your lender is required to automatically cancel PMI. But you can also request that it be removed earlier, usually when you reach more than 20% equity, as long as you're current on your payments and meet other lender requirements. Can I buy a home with no down payment? Yes, it is possible to buy a home with no down payment, but it typically depends on the type of loan you qualify for. The two most common loan programs that allow for zero down payment are the VA loan and the USDA loan. VA loans are available to eligible veterans, active duty service members, and certain members of the National Guard and Reserves. These loans are backed by the U.S. Department of Veterans Affairs and do not require a down payment or private mortgage insurance, PMI, though you may need to pay a one-time funding fee. USDA loans are designed for low to moderate income buyers purchasing a home in a rural or suburban area. These loans are backed by the U.S. Department of Agriculture and also allow for 100% financing, meaning no down payment is required, but eligibility is based on income limits and location. If you don't qualify for either of these programs, some lenders offer low down payment options as little as 3%, and there are also down payment assistance programs available in many states that can help cover some or all of the upfront costs. Are there any first-time homebuyer programs or grants? There are several major home loan programs available nationwide that can help make buying a home more affordable. FHA loans, insured by the Federal Housing Administration, are popular with first-time buyers because they allow for low down payments, usually as little as 3.5%, and more flexible credit requirements. VA loans, backed by the U.S. Department of Veterans Affairs, are designed for eligible veterans, active duty service members, and certain surviving spouses. These loans offer valuable benefits, including no down payment, no private mortgage insurance, and competitive interest rates. USDA loans are available to buyers purchasing in eligible rural and some suburban areas, and these also require no down payment and offer low interest financing to moderate and low income households. In addition to those, conventional loans backed by Fannie Mae or Freddie Mac, often called conforming loans, are widely available through private lenders. While these usually require higher credit scores and down payments compared to government-backed loans, some programs like Home Ready and Home Possible allow down payments as low as 3% with reduced mortgage insurance costs for qualifying low to moderate income borrowers. Now, each of these loan options is structured to support a wide range of home buyers, whether you're purchasing in a city, a suburb, or a rural community. Are there any hidden fees I should watch out for? When it comes to hidden fees in the mortgage process, it is important to carefully review all documents you receive from your lender. Most fees should be clearly disclosed in your loan estimate and your closing disclosure, but sometimes smaller charges like document preparation fees, courier fees, or rate lock fees can catch borrowers by surprise. These fees vary by lender and may not always be necessary, so it's a good idea to ask your lender to explain each charge and see if any can be waived or reduced. Being proactive and comparing offers from multiple lenders can help you avoid paying unnecessary fees. Can I roll closing costs into the loan? Many lenders allow borrowers to add some or all of their closing costs to the total loan amount instead of paying them up front. This can be helpful if you want to minimize out-of-pocket expenses at closing, especially when cash is tight. However, keep in mind that including closing costs in your loan means you will be paying interest on those costs over the life of the loan, which increases your overall borrowing cost. This option is more common with refinancing, but can sometimes be used with purchase loans as well, depending on the loan type and the lender guidelines. It's important to weigh the short-term benefit of reduced upfront costs against the long-term impact on your monthly payments and total interest paid.